Hello, I'm Alan Kohler, Editor-at-Large of Intelligent Investor and finance presenter and columnist and podcaster for the ABC.
And I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist. And we are the Money Café, Alan.
Money Café. G'day, Stephen.
Lovely to talk to you, Alan. Where do you want to start? I just read your column on the ABC this week about the budget. I think that was quite a sweeping, interesting piece. Why don't you start with telling us, as the dust settles on the budget, what do you reckon the government is doing and how's it going?
Well, I had 2 points to make in the column. It's always difficult to do a column where you're saying two things. But anyway, I think I managed to weave it together, which is the first thing was that I'm starting to feel like we will see more affordable housing, that all the things that are being done, including interest rates rising, which is not being done for housing purposes, but interest rates are going up, will all combine to cause house prices not to rise for a while. But the problem with that is that there is a dark side to that, which is what I pointed out, which is that a whole lot of people who bought houses recently in the last few years, and in particular we're talking young families with using a whole lot of debt, they did so on the understanding that they would acquire equity over time because house prices always go up. And so they are going to be disappointed, I think, if the government succeeds. And this was always going to be the case. I mean, you can't actually make housing affordable while house prices continue to go up, obviously. So therefore, all the people who've bought in the last sort of 5 to 10 years at very high prices, using a whole lot of debt, are going to find themselves not building equity as they expected.
Particularly those in the government's new 5% scheme, which was one of those last little encourage leverage, borrow up to 95%, will cover your mortgage insurance.
Yeah.
But aren't we all having conniptions? Isn't the response been, oh my God, auction rates are down a bit. Oh, volumes are down 15%. I mean, are we mature enough to handle a long overdue sort of modest correction in housing? Because the first sort of reaction has been, the sky's falling in. House prices are not going to keep going up.
That's right. Well, and we are in a correction. I mean, we got the May house price data on Monday, and the national median price increase was zero. There was no change nationally. Brisbane, Adelaide and Perth continued to rise, but not as fast as they have been, so their growth rate is coming down. And house prices in Melbourne, Sydney and Canberra and Hobart continued to fall. So there is a correction going on. I think the national house prices will fall. I mean, in the last sort of couple of decades, house prices have fallen 3 times by between 7 and 9%, so that'll probably happen again. I suppose I'm really talking about the 10 to 20 year time frame, and I reckon that we're in a situation now where house prices probably will not rise for a long time, like 10 to 20 years.
And a fair chance that volumes will fall, because if you're not a forced seller, and people generally aren't, and particularly with all those with grandfathering or grandparenting, why would you sell? Just, hang on to your negative gearing. So I reckon it's interesting. I reckon you may see the state governments losing some stamp duty revenue because turnover will change because people have less of an incentive to sell. Some people are saying, well, I'm going to wait for the correction before I buy. So, yeah, that's where you get that reduction in auction clearance rates, because buyers and sellers now just have different perspectives. The buyers are all saying, I'll wait for my 10% correction. The sellers are saying, I want to get last week's prices. And then you get a bit of a standoff and you get a reduction in turnover. So, and what about on the rents front and the building approvals? I thought the drop in building approvals in April, 3.4% drop, was a bit of a worry. John Simon warning on 7:30 the other night that rents are going to skyrocket. So,
look, building approvals are volatile. I think you need to take a bigger picture of those things. I mean, look at actual commencements and housing completions, and they are rising. I mean, they're not rising. The trend is definitely higher. It's not rapidly higher, but it's certainly increasing. And I think it's inevitable that would happen because, it's been now a couple of years now since the housing accord process began. I mean, for this entire 2 years, I've been reporting that that the housing completions are falling well short of the target that the housing accord set of 1.2 million houses in 5 years, which requires 20,000 completions a month to meet, and they've been 15 to 17,000 per month for a couple of years now. But I think that all the things that they put in place as part of the Accord, which is to tell councils to approve more housing and to shift the zoning and get new high-rise apartments built and all this, that's kind of now starting to work. I mean, they always said it would take a while, and it has taken a while, but it is now starting to happen. There's plenty of headwinds, such as construction productivity is still low. It's hard to get it up. They haven't been able to get houses built in factories, with prefabs and so on. That's really not happening to the extent that anyone wants. But there is a gradual rise in completions. There is a decline in immigration happening. I mean, it's nowhere near what Pauline Hanson would like, or Angus Taylor is kind of predicting massive collapse in immigration. It isn't, but it is coming down.
And speaking of Pauline Hanson, she's got a negative gearing policy of no more than 2 houses per person, which is would actually have a much bigger, particularly if you didn't have grandfathering, that would trigger a lot of selling. But what about the broader One Nation, the rise of One Nation? Like the Fin Review Redbridge poll, on Monday, the Fin Review went with the narrative of budget disaster for Labor, budget spurs One Nation vote. There's a little bit of chatter that, Labor could get spooked by the polls, by the sort of One Nation, now the most popular party, and could wind back some of their budget changes to focus mainly on just the property side of things and wind back some of the CGT on shares and trusts, et cetera, et cetera. So what's your take on the One Nation thing? I mean, we've never seen a duopoly busting rise in the polls like it. It's quite common around the world, but it's, it's not stopping, is it? They're not imploding, and it's going to have a massive effect, presumably starting with the Victorian election in November, when they'll probably do better than South Australia, where they got 10% of the seats and 23% of the vote.
Yeah, well, so the Labor Party's already spooked. The coalition's definitely spooked, and so they should be. I mean, Cos Samaras of Redbridge, who's been doing these polls, who was supposed to have lunch with today, but he's just cancelled on me because he's got some urgent job from a client. But he's been saying that basically the political duopoly in Australia is finished. It's over. We've now got 3 parties, and what's occurred is not so much a shift to the right, but a resorting of the electorate into new and different collections. And the supporters of One Nation are kind of people who are disenfranchised. They're sick of the system. I think one of the interesting things is that the American electorate got to that point 10 years ago when they voted for Trump, and it's taken us 10 years to get there. And I do think the difference perhaps is a slower kind of concern about immigration. I mean, I think 10 years ago, America was kind of really worried about illegal immigration and people coming across the border. I mean, at that point in Australia, we still had the kind of the hangover of Abbott's Stop the Boats and Labor's kind of falling into line with that, where there was offshore processing. So we didn't have the same kind of illegal immigration issue that America had 10 years ago. But
and
now
we didn't have the deindustrialisation, China, the hollowing out of the Rust Belt, and that their house prices hadn't risen like ours. So even people in Australia who might have lost their manufacturing jobs offshore to China in the textiles industry, they'd still seen their house price increase 3-fold. So they were feeling pretty good. Whereas in the US, they didn't have that. So the level of disaffection amongst the working Rust Belt people was the core of the rise of Trump. And we didn't really have that same level of inequality and disaffection. But now we do, we see, it seems.
We do, and I think that a lot of that has to do with the big burst of immigration after the COVID pandemic, which saw kind of, lots of big increase in immigration, 400,000 or 500,000 a year for a couple of years, which led to a housing shortage, a big rise in house prices, which was tempered a bit by the rise in interest rates in 2022, but then took off again last year with those rate cuts. So, I do think that now we're seeing the kind of consequences of all that in the rise of One Nation. And
I think also I think the combination of Bondi and the incompetence of the last coalition campaign under Dutton. So a lot of Conservatives, a lot of people on the right just looked at the coalition and Susan Lee and changing leaders and coalition breakups and incompetent nuclear policies and just said, we've had enough of you. We're going for the alternative on the right, which is different. Yeah. At least they're consistent. We know what they stand for. So I think it's partly an incompetence of the traditional parties of the right, and Barnaby Joyce giving them more credibility because he's a former Deputy Prime Minister and Nationals leader, and One Nation hadn't had a recruit like that.
Well, thank God One Nation is a competent, smoothly running machine. What do you think?
Well, everyone's waiting for them to implode because that's what's always happened in the past, and I still think that it will not get to a situation where they're forming government, but it's more consistent, it's holding up, they're less incompetent. I've tried startup parties myself. It's a very, very hard thing. If you're sitting up there in Queensland trying to roll out a campaign right across Victoria in November and run in all 88 seats and try and get 25% and get 20%, it is. Startups are hard in politics.
Yeah, but it's not. But so One Nation's not a startup anymore. Let's face it. Crikey, they've been going.
Well, but startup in government sense, I've been elected as a crossbench oppositionist. You can sit there and criticise, but being in government is hard. And they've never been in government in any coalition. They've never been a minority government. So they've never had the responsibility of actually having to be accountable for doing anything. Policies, it's just legislation tweaking and grandstanding and wearing burqas in the Senate and this sort of stuff. So this is where I think they will struggle, is the ground game. They haven't got the resources. I mean, Jenna Reinhardt, $1.5 million plane. The Victorian Liberal Party have got a $100 million share portfolio, and all that experience. So I think that, anyway, I guess I'm confused because I've never seen polling like it. So we're all in uncharted territory. And I guess many of us will sit there as traditionalists saying that the institutions will hold. But this is, we've never had a party that's topped the others. So, maybe this is different.
I better quickly say what the second thing in my column was about, which was why is the government extending the change in capital gains tax to from the 50% discount back to the inflation adjustment to business as well as housing. I mean, the whole thing is presented as a housing affordability package, but obviously it's also applying to business. Jim Chalmers says that's because we don't want distortions. We don't want investment decisions made according to tax reasons, and that's fair enough. But the trouble is they're getting hammered on this. Why? There's so many other tax distortions that more important tax distortions that could be removed, on which they could spend their political capital than that. It seems to me obvious that they should confine the change in capital gains tax and negative gearing to housing. And keep it at that and let business off the hook. Heavens above, why not? Anyway.
Well, I've got a few questions getting stuck into me for expressing that opinion too strongly last time I was on the pod with you, Alan. But I think everyone is surprised. The answer is, I think, that they felt politically confident, chaos in the opposition, etc., big second-term majority. And there was a whole bunch of long argued for things that Treasury had wanted to sort out with, trusts and then the argument of equality across the asset classes. So I think the policy consistency point was pushed by Treasury, and that met the philosophical goals of Labor, which is, it's too tough on workers and too easy on capital, which I think we've all agreed with in the past. So if I can just hit you with one of the criticisms of our readers, you guys have been arguing this stuff for years. Why are you complaining now? So what is the argument to that? We've all said capital is undertaxed relative to Labor. Labor's done something about it, and you're now saying they're mad and they should go back to and leave business alone.
Oh, well, I mean, the thing is that it's not much of a change. It isn't really. They're changing from a 50% discount to an inflation adjustment, and they're putting into the budget in 2 years' time $1.35 billion from it, and then 2.6, I think, the following year. It's not going to solve the structural budget deficit, and they can do it in other ways as well. I mean, I think that they should think about a wealth tax or an inheritance tax. They should certainly think about a resources tax, increasing gas taxes more, and they should think about increasing the GST, which is not a tax on capital, but it taxes everybody, including rich people. And the problem we have in Australia is that our income taxes are too high, so it's whacking effectively workers who go onto the top marginal income tax rate of 47%, including Medicare levy, at 190,000. Which is a very small multiple of the average weekly earnings of 1.7 times.
Well, all of what you've suggested is incredibly difficult politically. Death taxes, increase in GST, and that's why they've gone for something which is still difficult politically, particularly with the integrity point of the broken promises. But they've gone for it. What I really hope happens is that after 25 years of boring, do-nothing tax policy, that this opening gambit by Labor will lead both sides to actually take decent tax reform policies to the next election. So Labor comes up with an inheritance tax that funds dramatic reductions in income tax. And the coalition comes up with GST up to 15%. They actually both have a crack and have competing bold reform packages, and then you can choose from them. But the usual thing in Australia is one side's being bold, the other side says do nothing. And then you get the shortened outcome where the bold one gets smashed by the oppositioners do nothing, and then the opposition gets in with a do nothing mandate and they do nothing.
Yes.
It's the story of tax policy reform in Australia the last 25 years, since Howard was bold, put up a package, sneaked over the line and got the GST done, which was the last piece of decent tax reform policy. I mean, he did do capital gains tax in 2000, which was looking after his base, as in business and workers, business and capital. So that was all about the boom. We can give tax cuts, and rather than give it back to the workers, we'll give it to capital, and that was a significant policy. And also the super concessions were massively generous that Costello and Howard did. But now even that's being unwound. So it's an amazing time. At least it's interesting. Australian politics is normally so boring between tax reform and the rise of One Nation. It's finally vaguely interesting.
It is vaguely interesting. Let's face it. Now, we've got a lot of questions, but before we get on to those, as usual, we do. The AI bubble is taking off again. I mean, if you look at it, if you look at the share prices of the AI stocks, they started taking off at the end of March. I mean, they'd been kind of static or falling for a while, 6 months, 12 months. And then bang, in April and May, it's been absolutely phenomenal, incredible.
Well, the Nasdaq's up 20% since the war, and the Dow is up 10%. So there's been no market impact. The AI boom has just absolutely railroaded Iran concerns.
Yeah. I
mean, yesterday, Google did an $80 billion secondary equity raising. Google, I mean, they've got $126 billion in cash. They don't need to go out there and raise $80 billion. And you've got these 3 IPOs coming up with the trillions, SpaceX, OpenAI, and Anthropic. And then even this morning, Jensen Huang's been in Taiwan at the big chips conference, and this morning, overnight, he had the CEO of a company called Marvell Technology, a guy called Matt Murphy, and he said, "I predict Marvell is going to be the next $1 trillion company." And they make AI chips. They're based in California. Shares up 30%. 30%. And then last week you had Dell's quarterly result. Shares up 30% because Dell was actually making real money. Like, that wasn't a bubble. But I just find this whole thing, where's the cash going to come from for these big $1 trillion IPOs? And I think Google's tactic is, well, if they're going to drain the market of trillions or hundreds of billions, let's go out there and help ourselves to 80 billion at bubble prices ourselves. So
yeah,
Google's
that's right.
just going, and everyone's going, this is jumping the shark. Google going, give us 80 billion is jumping the shark in terms of how much capital markets are prepared to throw at this bubble. And it is an absolute bubble. And the capital spending is extraordinary, but the markets are believers. So what do you do?
SpaceX has filed for a public float, and it's basically an AI business. It's not really a space company. It's an AI company, and they're forecasting massive AI for profits. We've got OpenAI and Anthropic also coming up. Anthropic's announced that it's confidentially filed its prospectus to the regulator. So they're coming up. I mean, it's going to be a triple whammy of massive floats, the biggest of all time. All based on AI. So it's going to be an interesting question as to how the market absorbs this and what happens when those three stocks join the indexes and all the passive ETF investment funds have to invest in them and they have to sell something else to buy them. And so there's kind of a lot of people are saying, well, what's going to happen then? How's it going to work?
We might look back at this time in 5 years and say that was peak bubble and index gaming, that whole exercise. Because, I mean, I'm pretty upset with the SpaceX thing. I mean, I got an email from CommSec last week spruiking it. And the idea that CommSec, our biggest broker, is spamming hundreds of thousands of their customers. They don't normally email us with, hey, new IPO, get on board. And then I read, that SpaceX is looking to get $1 billion out of Australian retail investors, And
really?
30% of the raise globally is retail. Musk is just an evangelist spruiker who retail shareholders love. And he's now spreading this disease to Australia and attempting to get $1 billion out of Australian retail investors. And CommSec has agreed to be in on the giggle. And, total addressable market, $34 trillion in space. And, the thing's blowing cash, absolutely blowing cash. It's a gerrymander. He's got 85% of the votes. It's not one vote, one value. He's unhinged. It's bleeding cash. And they're trying to get $1 billion out of Australians. I mean, I'm really upset by it. And, SpaceX spent $150 million buying Cybertrucks, propping up his Cybertrucks business the other week. And SpaceX has got $29 billion of debt to start with. Starlink's a great business, but the rest of it's just bleeding cash.
We've got to get to the questions, Stephen. We've got to get to the questions.
Sorry,
so before we do that, here's a word from our sponsor first.
If the federal budget CGT changes have you thinking harder about what to do next, Intelligent Investor Essentials can help. For just $297, Money Café listeners get Alan Kohler's Weekend Brief, exclusive market updates, subscriber-only podcasts, a limited edition cap, and 3 months of Intelligent Investor Premium. That's $726 of value for just $297. Go to moneycafe.com.au before the offer ends. T's and C's apply.
And just before we have the questions, a general advice warning. This is general advice only. Do you want to do the Matt question first?
Yeah, so Matt has written in. Now, Matt runs a business called Tamarama Music, and our chief producer, Greg, is a big fan of their great service. And Matt has gone in quite a detailed question, basically complaining about the latest Australia Post price increases. And, there's fuel levy costs jacking up the prices, another 5% increase from July 1 on their average parcel post. And he's saying this is hurting businesses all over the country. Like he sends out, microphones and all sorts of gear by post. People order online and he's got to post it out. And I think he's making a really good point that the government, with the monopoly with Australia Post, should not be stoking inflation with above inflation increases in basic utilities that are so important for the operations of the economy, such as Australia Post. But then I had a look at the Australia Post annual report, Alan. 9.5 billion of revenue, and last year they only made 19 million in profit. So they're not gouging and making huge profits. They're simply passing on the rising costs that every other business is facing, and they've got falling volumes, obviously. But those who are still reliant on the postal service are getting absolutely stiffed. So Matt's right. And what do you do? I mean, should the government just overtly subsidise Aussie Post and provide services at below cost? Where are you on something like that?
Well, obviously they're losing tons of money on letters, and they're subsidising the Australia Post is internally subsidising the letters with parcels. And in the parcels business, they're competing with, the big global outfits. I think the competition in parcels is probably keeping the price down, but they're having to put the price of stamps up to try to make some money there. I mean, I think you can make an argument, and Matt makes it, that maybe the government should just continue subsidising letters for a while and not.
It's actually interesting. I keep hearing from companies and the share registries about how Aussie Post keeps putting the prices up so much. It's prohibitively expensive to send out notices of meeting in by post or capital raising offers by post. And so we've had this collapse in participation in voting. It's below 1% basically. And you get this hopeless levels of participation in capital raisings. And one of the reasons for that is it's so prohibitively expensive to use the old paper method, which had much higher levels of engagement in both voting and participating in capital raisings. Yeah.
So paper's got higher engagement, does it? No.
Oh, look, I think there was one time I ran for the Commonwealth Bank Board, I think 70,000 people voted. Because everyone got a paper ballot and then a reply paid envelope. So you'd fill it out and you'd pop it back and the company would pay for the post. Now you just get a little email saying click here, go online, and no one does it. No one even knows there's a capital raising offer, and participation rates, even when they're wildly in the money, a participation rate in a capital raising like a share purchase plan will often be 15%, 20%, even when there's easy 20% profit to be made. So I'm blaming the move away from paper for the crisis in democracy in corporate Australia and the ongoing shafting of retail shareholders who don't know how to navigate online to avoid themselves by being deluded by participating in a capital raise. Anyway, I should stop the rants. Your turn, boss.
Will, who is a chartered accountant and registered tax agent, says, love the podcast, giving you a 5-star rating on Spotify. Well, thanks very much, Will. That's excellent. Me and my best mate love discussing your insightful podcast, and my wife has also been able to get into it a bit, helping us stay in full. G'day, Will's wife. I'm writing to suggest CGT discount impact on startups is overblown in the media. Small businesses are still eligible for the small business CGT concessions, so this only affects those who do not meet the small business CGT concession eligibility criteria, or they are selling for so much money they exceed the limits. I don't even know what those limits are, actually. Noting this, if reform is required, maybe they could tweak the criteria for small business CGT concessions to be less strict around the ownership CGT concession stakeholder requirements. Well, we'll take that as a comment.
Yeah, but I think it is an interesting point that, the concessions are things like if your net assets are less than 6 million, if you're retiring, if you're buying another business, so you can sell your business, and as long as you buy another business, you get the sort of rollover relief, and there's also a 15-year rule. So there are 4 areas of concessions, but I agree with Will that they probably will need to tweak them if they're going to limit the political damage, because people are pretty furious, and it is a significant increase. And then I don't know how they're going to do the startups thing, because that's just going to be treating one sector different from others, and that's always difficult to do with policy. Now, Anonymous says, I'd be keen to know if you had any of your cool graphs on growth by sector and growth by size of business. Specifically, it feels like businesses for both retail and small hospitality have been in recession for about 15 quarters. With rising interest rates, this means stagflation in these sectors for the last 2 quarters. My sense is there will be a lot more than the usual closures in those areas in the next 6 months. Well, this sort of goes to, a bubble hurts other sectors that are not loved. And look, there's a lot of talk about retail. Poor old Myer shares, Alan, they were $1.24 18 months ago. They're down to 24 cents. So, yeah, restaurants, hospitality, retail. You got any graphs on them, sort of backing up the anecdotal sense that they're really hurting?
Oh, could just have a graph of my share price, I guess. That's true.
Yes.
Wouldn't be too hard. But yes, I think the retailers, those kind of retailers are struggling. Yeah. Alistair says, of course, as this general advice only, what are your thoughts on the SpaceX IPO? Potentially a good investment with a bright future, or is it the big money cashing out before it all goes belly up?
Well, you know my view, Alan. What do you think?
Well, look, I think it depends a bit on whether there really are going to be data centers in space, which Elon Musk has been talking about for quite a while, and it does make sense. And the thing that got me interested was that they're starting to negotiate now a deal with Google where they will actually do it and put data centers in space, because being closer to the sun and outside the atmosphere, you get much more energy, solar energy directly onto the solar panels, and it doesn't, it's not too hard to sort of get the data back down just through microwaves. So I think that there's a fair chance of that, and also they're starting to hit a lot of constraints in with data centers on the ground, not just electricity constraints, which obviously they're all starting to bump up against the capacity of various electricity grids wherever they're being built, but also zoning. I mean, the community is starting to jack up about all these massive data centers being built near them. So I do think there's going to be a limit to how many data centers can be built on the ground.
Well, apparently there's 4,100 data centers in America already, but the CNBC had a big interview yesterday in Michigan, the biggest one they're building. They interviewed Sam Altman there, and it's going to cost $45 billion to $16 billion to build it, and then the cost of all the chips. And it's like 1.4 gig. So it's absolutely enormous, the amount of compute. And they've got their own cement plant, their own steel making plant as part of this whole sort of a campus, they're calling it, with 3 different towers. So the scale of the thing is just extraordinary. And how you can invest $45 billion on one site in Michigan and get a return, that's where a lot of people are saying, I don't think the economics are going to add up. But then you got Anthropic, where people say, well, they're now doing annualized revenues of $47 billion and they're going to be cash flow positive in the next quarter. So their business is looking real. But SpaceX and OpenAI, $1 trillion valuations, I struggle to see how it stacks up.
Yeah, I don't know. I mean, look, I'm not going to be buying shares in the IPO, that's for sure, because I don't to do that because most IPOs turn out to be bad, or at least in the short term, you don't make money. You're better off buying them when they come on the market afterwards. Whether that applies to SpaceX, who knows? But I
have the same approach, but I'm very nervous about the index ETF side of things, because it is a phenomenal change in the way markets work. And if you suddenly get a rails run into these indexes and all the index funds are forced to buy you, that can lead to quite irrational share prices, because you've got BlackRock and State Street and Vanguard just buying with their ears pinned back because they have to under their passive investment mandate. So if they can establish a valuation of $1 trillion and get that backed up by index weightings, then that just creates a wall of buyers that potentially perpetuates the distortion of the valuation until ultimately the cash flows, profits and dividends come home to roost. But by then, they might have been long gone with your loot, sort of thing.
Probably should go straight to Mark. Yeah, your turn.
Yeah, Mark says the proposed changes limiting negative gearing and CGT concessions to new homes have a massive blind spot. They destroy the secondary market. If concessions only apply to new builds, the next buyer gets zero tax benefit with no incentive for a subsequent buyer. The resale market evaporates. Look, that's an interesting point, Alan, isn't it? So Harry Triggerboff's very excited about buy my apartments off the plan, get your negative gearing, but then if you've bought that and then you go to sell it 6 months later, who's the buyer? Because all those investors are no longer in the market as buyers. So you've only got the first home buyer. So you can just imagine people excitedly buying an apartment off the plan for $900,000, looking forward to the depreciation schedule on the carpets and the curtains and everything else. And then they go to sell it in a year or two's time and they took up a capital loss of 150 or something.
Yeah, well, so don't sell it in 6 months or a year. I mean, the thing is that what this means is that housing needs to not be like private equity where you flip it after a couple of years. It needs to be bought and held. It isn't something that can be just kind of a speculative investment that you flip.
And negative gearing, particularly on new builds, it does to encourage holding for 5 to 10 years because it takes that long to really work through all the depreciation, and get your tax down. So you're really doing it when you're in your maximum wage earning years and you're sick of paying $80,000 to the government and you only want to pay them $60,000. And so you just do the negative gearing through those high paying years. And if you can later live in it, or one of your kids can live in it, or that's the game. So I don't think you're going to get negative gearers flipping. But I do agree with the argument that it'll prop up the purchase price off the plan, and the secondary market will be weaker. So don't expect to be doubling on your new apartment anytime soon.
I think Mark's point is that the fact that the secondary market is not there, he says, will mean that the primary market, the first buyers will kind of think twice, because they'll think, oh crikey, I can't, there'll be no market to sell this asset if I buy it, even with the negative gearing. So look, I think that. And
apartments are the most affordable part of the market. So a lot of people's first purchase is an apartment. So I hope we don't see massive growth in apartment prices. I mean, if people are going to be able to get into a home and rent, we need more construction. So hopefully we will get, investors supporting off the plan purchases that make projects stack up economically, and Harry can go out and build, a few 10,000 apartments to add to his $29 billion wealth or whatever it is. So.
Yeah.
All right, your turn, boss.
Ethan says, most can see how disincentivising property investors from buying more houses is theoretically helpful to first home buyers, but how can anyone accept that at the same time increased taxes on young people's shares and crypto assets, increased taxes on their businesses, and ever-increasing government deficits will somehow solve intergenerational inequality? Who's paying off the never-ending debt? I think this just raises the point we haven't discussed, which is that the CGT tax changes include a provision that says the minimum tax now on capital gains is 30%, which is an interesting addition. It means that young people who are on a low are on low wages and therefore a low marginal tax rate, if they make any money from shares or any kind of capital gain, they have a minimum tax rate of 30%, even if their employment marginal tax rate is 16%, or perhaps even zero, because they're making less than the tax-free threshold. So that's an interesting and unexpected kind of addition to the whole thing.
I'm surprised that's the bit that I found the most objectionable in the whole budget, was that they went for this flat 30%, no matter how poor you are. Although, as one of our questioners has pointed out, there is an exemption if you're a pensioner. So if you're a pensioner, it doesn't the flat 30% doesn't apply. So this person who's written in is saying, well, if I'm a self-funded retiree, why is my neighbour who's on a part pension being taxed lower on their capital gains? Now, I think the principle in taxing surely should be consistency, and I would have thought consistency, whereas you don't discriminate between labour income or capital income. Your tax-free threshold free, 18,000, applies whether it's capital or share. So I'm really surprised that the Labor government's gone for that. I suspect that might be an area they tweak.
No, well, what they're doing is they're making it consistent. They're making capital gains tax consistent with the new minimum tax on trust income of 30%. So that's their concern, was that people would, if they didn't make the minimum tax on capital gains tax, the people would use the capital gains to split income, because they're trying to attack income splitting to get tax down by splitting with your children or your spouse who are on a lower tax rate, and they're trying to stop people doing that with capital gains as well, if they're putting a minimum tax rate in trusts of 30%. So I can see what they're trying to achieve, but I think that it's having a pretty poor unintended consequence.
Yes, but meanwhile, if you're in super, your capital gains tax rate's only 10%. So, so they're not being consistent. I mean, super's just a special. Super's like the Vatican, just totally protected and special. Now, we did have a question. I'll just summarise it. It was later on in the piece. We've got like 20 questions, but one person wrote in and pointed out that there used to be a provision back in the old days when you had the CPI thing of the 5-year smoothing provision, where if you did have a capital gain in the 90s, you could smooth it out over 5 different income tax years. And that's not proposed to be coming back when we go back to the 1999 rules. So this correspondent was saying that it makes the changes even more brutal, because it's not returning to the old system. It's returning to a tougher version of the old system, because we used to have this 5-year smoothing where you could spread your capital gain over 5 years. And now if you have your windfall in 1 year, you're going to cop the full amount in that year and you're going to be up to 47% before you know it. So maybe that would be a little compromise, is to return to the 90s era smoothing of your capital gains over 5 years.
Yeah, okay, fair enough. That's good. There's someone getting stuck into you here, Stephen.
Oh, there's quite a few people getting stuck into me for being too critical of the government. You're a bunch of hypocrites. You've been calling for these sort of changes. So, as I said earlier, I was most upset about the integrity piece. As a occasional poorly paid part-time politician in local government, there is integrity. We've got trust losses. To come out and just throw everything out that you've promised, I found that challenging. But look, I take the criticisms and look, at least they're having a go. I will be positive and say I'm glad they're having a go. I do agree there should be more tax on capital relative to labour. I was disappointed they didn't offer some tax cuts to working middle Australians, because we've got some of the highest rates in the world. But I take the criticisms. And
Peter says he's been enjoying the podcast until recently because of your increasingly partisan commentary on the budget.
Yes,
are you
once
partisan?
a Liberal Party spin doctor, always a Liberal Party spin doctor. Well, I was disappointed. I had a crack. I did once work for the Liberals. Maybe I'm a partisan. I don't know. But maybe we can get onto something else. Julian says, have you been watching Sean McAuliffe's new documentary Going for Broke on the ABC? What were your thoughts? Why are we so obsessed with gambling in this country?
Have you watched that?
Look, my mum rang me last night, very excited, telling me it was so good and I had to watch it, and I haven't watched it yet. But I know he's brilliant and I am going to watch it. And I did hear, even Bob Carr the other day came out saying we've got to increase taxes on pokies. And New South Wales pokies revenue is going to hit $10 billion this year of the $30 billion. So New South Wales is the biggest gambling jurisdiction in the world. Every street corner in the CBD seems to have a pokies pub with 30 pokies. So I agree with Bob Carr. Forget about taxing gas. Tax the pokies clubs and pubs. I mean, Arthur Laundy's now worth $1.9 billion. All these rich listers in the AFR rich list of, the pokies pubs. And the clubs, they don't pay corporate tax. Tax the Penrith Panthers, make them pay 30%. I mean, they're tax exempt and they're bleeding the community dry. So I agree. It's a disaster that we're blowing $30 billion a year gambling. And well done, Sean McAuliffe. But, the Labor Party owns 4 pokies venues. They're in on the giggle themselves. Catholic Church even owns pokies venues. It's just so entrenched. It's very, very difficult to wind back, 200,000 poker machines in 5,000 venues all over the country, bar WA, which never introduced them to their benefit.
Yes.
That's my final rant for the day. I'll let you choose the last question, boss, because we're almost out of time.
We are almost out of time. And the last question, well, they're all about taxes and CGT and...
Actually, I liked one, Lynette, I think it was, or we had one that made a really good point, is that those working in the charitable sector, there's a $15,900 FBT benefit that was introduced 25 years ago to make it more competitive for charities and not-for-profits to hire workers. So you're able to hire them and you get this $15,900 benefit on your FBT. And that hasn't been indexed for more than 20 years. That's the criticism. So it should be $30,000 now. And I guess my thought is, look, it's a fair point. It hasn't been indexed. But given that charities don't pay corporate tax either, there's also a question of competition and how level the playing field should be. And the charities already have it pretty good, as in they can offer workers, this $15,900 FBT benefit, and then they don't pay taxes. So I don't know. But look, it's a fast-growing sector. There's lots and lots of, the big Anglicares and the Salvos. There's endless work and endless new government contracts. The care economy. It's a big growing part. But, it's always nice on the podcast to get a new policy question like Aussie Post gouging people, and this point about the lack of indexation of the number one tax benefit designed to make the charitable sector do well and be attractive. It hasn't been indexed for more than 20 years, and
I think that's an interesting point. I didn't even know that, so that's interesting.
There you go. We learn something on the Money Café, Alan, hopefully. Every week, hopefully, when you're in the gym talking to your best mate, you can say, I learned 3 things today. And there you go. Aussie Post, they should cut their prices, says Matt of Tamarama Music.
Paul Graham of Aussie Post won't agree with that, that's for sure.
You know who's on the board? Anastasia Palaszczuk. She's the only political person on the Aussie Post board. The rest are regular, solid corporate types. And but the minister ultimately controls some of those price changes. So blame the politicians, not Aussie Post, I say.
Thanks, everyone, for listening to today's episode of The Money Café. I'll be back next week with James Thompson, as usual. So send in your question to themoneycafe@intelligentinvestor.com.au, and we will genuinely try to answer it as long as it's short. Please keep it short, and we'll answer as many questions as we can. Till then, I'm Alan Kohler, Editor-at-Large of Intelligent Investor and finance presenter, columnist and podcaster for the ABC.
And I'm Stephen Mayne, contributor to Intelligent Investor, founder of Crikey and shareholder activist, and we'll see you in a fortnight.